So here we are back at the assumptions and drivers section of the model that I showed you earlier. We're going to take some of the information that we were given, some of the qualitative information, and start thinking about how that may inform assumptions and drivers in this model. In particular, want to make sure that you're following along to see how these changes affect the income statement as well as the cash flow statement. We're actually only going to look at 3 line items, which are here, 2 from the income statement and 1 from the balance sheet. And I'll explain each as we go through. So if ABC Sporting Goods is bringing on Walmart as a client, we know there's going to be a big jump in sales year over year in the current year. The current year, of course, is forecasted because they're only part of the way through. So let's say, taking from what previously would have been base case estimates of 6% with a 55% gross margin, we know that sales growth is going to be very, very high this year. And perhaps it's a little bit higher than projected as there's carry forward. And then let's say, as we go through our projections, that it drops down to something a little more modest. One of the things we know, given the information in this mini case, but also just through common sense, is that their pricing power is going to be eroded because of the volume that a big buyer like a Walmart is taking. That's going to put downward pressure on gross margin. So let's assume, if we thought there was perhaps going to be 55% gross margin in our base case, that this drops all the way down to, let's say, 51. Remember, not all of their sales are going to be affected, but certainly the sales volume that's going to Walmart. And then we can assume perhaps they recover some of their pricing power going forward, get back to something a little more normal looking, maybe not quite 55%, but a higher number. And we can see how that affects our income statement as well as our cash flow statement by way of cash flow from operations. We can take these off now using McKinsey shortcut, Control-Shift- to remove the outside borders. You'll see we talked earlier about spark lines, which are here. Again, we only have 5 years of projections, but if you were looking at 10 years or more, it's a lot of information to digest, whereas the spark line shows you quickly big jump in sales year over year and in year 1 of the projections, and then something much more modest going forward. Now, working down to the balance sheet, there's something else really important that we were told in this case. When we start thinking about big buyers that put a lot of pressure on their suppliers, of course, remember, ABC Sporting Goods is a supplier of Walmart. We know that these large companies drag out their payable days. This is definitely a bit of a weakness and potentially even a threat to this business, depending on the magnitude of how long they draw out those receivables and what kind of impact it could have on ABC's cash. Of course, Walmart's payables are ABC's receivables. So if our base case assumption was 60 days, what would happen, and I want you to watch the cash flow statement here, if the average receivable days was dragged out now to 70 days? And you see a big drop off in cash flow from operations. That may carry forward into subsequent years, and perhaps they recover a little bit, let's say 68, 66, maybe 64. We start to see the cash flow statement stabilize with cash flow from operations going up, but we do see a very big drop. The cash position goes down considerably year over year in this scenario because so much cash is being tied up in accounts receivable by virtue of slower payments coming from this customer, which is Walmart. We'll toggle off our border. The other thing that was introduced in the case was the tax rate. One party may go up, one party may go down Because this is so close to the bottom of the income statement, it would have a much more modest effect on the net earnings of this company, and it would have no effect on EBITDA because, as we know, taxes are added back to EBITDA. But you can see here, just by changing a few assumptions based on the qualitative information that we've been provided in this scenario, of course, we were given this information in a case, but it could be that you uncovered some of this through management interviews if you were working with smaller private companies and so on. And you can see how we take some of this qualitative information and how it can have a very, very serious impact on the company's financial results as you start to think about and conceptualize how qualitative information translates into a financial model and into quantitative analysis. Let's look at another case study. MDM Medical, a medical device manufacturer. Again, we're not going to provide you with a lot of data points, and we're cherry-picking frameworks here for illustration purposes. Part of an analyst's due diligence will be seeking out other data, as well as conducting management interviews and other types of primary research. Of course, CFI has many courses available to our members that will round out your ability to conduct due diligence more effectively. This is just a quick example. For now, let's start to put together a simplified PESTEL analysis to better understand the business environment for a company operating in this industry. Healthcare reform in the US is a constant overhang for the sector. We could probably classify this as negative. On the other hand, the healthcare sector and medical device manufacturers specifically have relatively low sensitivity to economic cycles, largely since they aren't as levered to consumer spending as, say, the restaurant business. This is a positive. But let's say we're in a rising rate environment. This is generally not great for manufacturing businesses, which tend to borrow in support of CapEx, which we'll see. There are clear industry tailwinds when you consider demographic trends. The US population is aging, and this increases demand for medical devices across the board. An interesting technological trend in healthcare is the growing popularity of what's called minimally invasive procedures, meaning surgical procedures conducted using arthroscopic technology, as opposed to more traditional invasive procedures. We actually don't know yet if this will serve as a positive or a negative catalyst for MDM. Same with an important environmental trend that we've identified. There is considerable and growing scrutiny around the types of materials and where they're being sourced that are going into medical products. This obviously presents both risks and opportunities. We don't know enough about MDM to decide which here, but as an analyst, you'd want that to help inform your line of questioning for management. And finally, an important legal factor is the constant overhang of potential liability from faulty products. Massive recalls can create black swan type uses of cash in the form of court-ordered settlements. We'll forego the industry analysis here in order to jump right into some company information and to explore some business-level frameworks. MDM Medical is a device and supplies manufacturer founded 18 years ago. They produce a variety of surgical instruments like forceps, clamps, and suture kits. The company's flagship product, which currently represents about 40% of total sales, is what's called their IP7 scalpel. It's widely considered a best-in-class product. You'll recall this as a competitive positioning, best product. The company started out using a network of distributors, but has built such a strong brand and loyal following that it rolled out its own sales force 5 years ago. The company has terrific relationships with about 150 hospitals and ambulatory surgical centers across the southeastern United States, with no significant customer concentration risk. Historically, management tried to avoid single-use disposable products as they were considered low margin, things like gowns and latex gloves. Now, however, operating at scale, management feels that these product offerings are starting to look like an attractive way to drive incremental revenue. Projections suggest 12% in the first full year of operations after deployment. They're confident that they can shift towards more of a total customer solution strategy by introducing them, with the ultimate goal of leveraging their strong relationships with existing customers to boost sales without sacrificing much in the way of margin, maybe as little as 1 to 2 percentage point decrease in gross margin. This too may sound familiar from the course. You guessed it. This is a product development growth strategy as per Ansoff's matrix. Management considered several acquisition targets to simply buy production, but ultimately decided to build out their in-house capabilities and try to produce gloves, gauzes, gowns, masks, and the like internally. We know that this will require investment in both research and development, or R&D, as well as in productive capacity, meaning CapEx for plant and equipment. As an important aside, management has indicated that they intend to debt finance some of this capital expenditure. Going off the information in our PESTEL, as well as what we've been told here about competitive positioning and growth strategy, what types of assumptions do you think we would be focusing on? Let's have a look. Here we're back at the assumptions and drivers section of this base case model, and we're working off of the same base case assumptions as with the previous client, and we'll make amendments going forward based on the information provided to us in this case. In this situation, more line items were affected because we were given more information. So some of it was around competitive positioning, some of it was about growth strategy. Obviously, MDM Medical is looking to create new products to sell into existing markets. We also worked through a very basic PESTEL analysis, so we have some information about the broader economy as well as the business environment in which this company is operating. In this case, we're going to actually start with the balance sheet. So we know that this company is going to have to make cash investments into CapEx, capital expenditures, in order to have the productive capacity to create these new products. So the easy way to model that is by reducing our capital asset turnover ratio, which will in turn increase the assets on our balance sheet. But if you watch the cash flow statement on the right, you'll see that is a use of cash and cash flow for investing. They're going to start in the current year, so let's throw a number in like 3.75. Perhaps that carries forward into the next year, and then maybe we see it start to stabilize, something closer to our base case 4.25. We were told that management is looking to debt finance some of this, some perhaps all of the expansion. We don't have all of that information. That would be part of your due diligence. But let's say that debt increases materially in the current year to help fund some of that capital expenditure. Take a look at the cash flow statement. We can assume that some or all of this will be drawn into the subsequent year. Perhaps they start paying some of it back, and then we get something closer to their baseline of $20 billion in debt. So you can see already big impacts to the cash flow statement. When a business is reinvesting for growth in this type of nature, you may also see things like the payout ratio get reduced in order to help conserve cash. So to recoup some extra cash, we may see something like a reduction here in the payout ratio. Now let's turn our attention to the income statement. Management suggested that in the first full year, we may see something on the order of 12% growth in revenue. Well, that's not this current year. That's starting next year. So here we can have a big jump in revenue. And maybe that carries forward 8%, and then we see something closer to baseline going forward, but of course off of a larger base of revenue. We also know that the gross margin may be affected slightly. They said perhaps 1 to 2 percentage points. We could say 2 full percentage points here just to get a sense of what it might look like. Again, that won't occur in the current year, but certainly going forward within the first full year of operations with their new product offerings. So let's say 53, and let's say that holds all the way across into 2026 forecasted figures. Beyond just CapEx, we know when there are new product offerings for a company, significant spend needs to go into R&D. If 2 to 2.5%, let's call it 2.3, was the base case estimate, we may see in this instance, in the current year, we may see them ramp up to something on the order of 4% of revenue. Again, we would have to interview management, better understand the benchmarks and what's going on in the industry, but we could assume that a significant increase would occur in research and development. This may come off a little bit in subsequent years. Let's say 3.5. Maybe that comes down, no, we'll say, 3.5, maybe 3, and then something like 2%. You can see how that affects the company's bottom line here and their EBITDA figure. And finally, we also know, or we're told, that we're in a rising rate environment. That's something that you could only know by analyzing the broader economy. Well, this company, as we see down here, has taken on considerably more debt, and that won't be repaid in the near term. So rising rates are going to affect that company a little bit more in the near term. Let's say 6.75 in the current year, and that's going to jump up again, maybe 7. Let's say 7.5. Maybe we get to 8% if we're in a really, really high inflation environment and central banks are raising rates. So you can see the cash flow statement and the income statement have changed really rather dramatically based on some of the information we were provided in this case, both at the balance sheet level and the income statement level. Again, this exercise is not intended to teach you how to model, but rather how to think about and how to conceptualize information that you're provided, whether it's in the broader economy or within the context of the industry, and how you might start thinking about translating those into model assumptions in order to be able to conduct much more comprehensive quantitative analysis for a company. Hi, and welcome back. In this course, we discussed some different factors that create opportunities and risks for a business. Understanding these factors is critical for success in so many finance, consulting, and management roles. Now, you should be able to define key categories of growth drivers and business risks, compare different business analysis frameworks, define how economic, industry, and company level characteristics may influence business strategies and outcomes, interpret the results of qualitative assessments, and explain how these results may inform financial analysis, including model assumptions. This course is just one step, albeit an important one, in your career journey. We hope that you'll consider learning with us again and immersing yourself in CFI's library of content and resources to help propel your career forward.